The stock markets have gone berserk. We've seen the prices go to the moon. Can they go higher? That's what I want to talk about today. We are looking at what's been happening in the markets every single day, it seems. It's green after green after green. A red candle somehow seems impossible. But the first thing I want to look at today is the market mayhem, because some people believe that what we're seeing here is not good in the longer term. We'll talk about that. The second thing I want to look at is the distortions that have been created by the central bank intervention. I've got all of that and more. Let's begin. Okay, so let's start here. This chart comes from JP Morgan. Actual and fair value estimates of the S&P 500 index. You could see here what has happened since the financial crisis, essentially. Fair value would be much, much lower. And we all know this. But what has happened here is that we've had excessive, truly excessive intervention, stimulus measures. And so what does this all mean? It means that at this time, we are noticing that the Federal Reserve has more power than ever before. They are able to move and manipulate the markets just with their words, as they call it, the forward guidance. However, what if it turns out that the Federal Reserve and their words were very incorrect? They keep discussing transitory, but you can see, just like what happened in 2020, it fades away. And you notice their speeches a little bit, time and time again. We've been noticing this. They've gone away from this whole transitory. Yes, their official FOMC statements, the meetings, the minutes, they all say transitory. But if you look at the sort of more candid interviews, it's not really the case. They say, well, you know what, we're kind of worried about that, but we think we're still on track. We think we'll be okay. And so the biggest worry right now is that inflation is not transitory, that it persists for much longer, and then the markets will finally react accordingly. At this time, though, that's not the case. The markets are loving it, and we know that. So for the foreseeable future, markets are happy. But I want you to keep that in mind, because it is important. Market's biggest bull sees year-end rally, but warns it's setting up Wall Street for a scare next year. So remember, the guy is massively bullish, but he's saying, watch out, okay? A melt up to a 10% correction. You are going to bring equities to a level that they can't sustain. We'll have the equity market melt up. We'll bring stocks to a level where the fundamentals and valuations don't support them. I would argue that we're way beyond that today. We're seeing a lot from individuals and investors that they feel like the market is unbreakable at this point in time. We've had several pullbacks. You've bent it, but you've never broken. That brings another level of fear of missing out, and that brings in a level of confidence. It's late in the bull market. Now is a period where irrationality becomes much more rational. Things you don't expect to happen can happen, and most likely will. And of course, this is what we should be aware of. Just look at what happened before the last 5% correction in the markets. That was largely expected by basically everybody. And essentially, you look at this period of time, seeing the markets just going berserk. Here's lumber. You could take a look at the 4 major US indexes all across. Largely, I mean, this is short-term time frames I'm looking at here, but they've all done very, very well. Extremely well, in fact. On the right-hand side, I'm just looking at the Russell. the small caps, and that one has not performed anywhere close to what we've seen with the NASDAQ directly beside it here. But in general, these markets have responded very, very well to inflation as you see it. This happens to be Bitcoin. And Bitcoin, while it's off from its high, it's still at the time of this recording around 57,000 or so. So I just want you to know what's happening in the markets as a whole. And we have this. Market is one more bad inflation report away from a correction. This is according to Jeremy Siegel. Now, I talked about this in the previous video, but take a look. If the Fed suddenly gets tougher, I'm not sure the market is going to be ready for a U-turn that Jerome Powell can take if we have one more bad inflation report. A correction will come. He's just talking about a correction, by the way. He's not saying the market's going to crash 50%. And we saw that just a little while ago. A correction, depending on the stock, depending on the index, it was down 5%. Some things were down actually more than 10%. A correction has, many different definitions. It's supposed to be 10 to 20%. Generally, since the Fed has not made any aggressive move at all, the money is still flowing into the market. The Fed is still doing the quantitative easing. There's no alternatives. Cash is not an alternative because why? There's no return there. So there's a lot to this, and I simply want you, as I mentioned previously, think about all of this. Think about what's happening in the markets. Look at this, have your finger on the trigger, and be ready. Just be ready to make a move. Let's break this down in the Money GPS Insights. At this time, markets are overvalued by just about every single metric. But remember, markets don't fall because of overvaluation alone. There's much more to it than that. Watch very closely at the details of everything that's happening today. You must right now also invest with prudence. Don't simply go pedal to the metal, leverage, and margin. And of course, you must remember that inflation is on everybody's mind. It's in the market, it's out there. So keep that in mind when it comes to what you do with your money. I want to take a trip back down memory lane for just a second here. From Morgan Stanley, relative performance of US equities was much more mixed before the global financial crisis. And today, certainly everything has gone up, but take a look. This is the yellow line, the 12-month change in the MSCI USA versus the All-Country World Index excluding the US. It's up, it's down, it's up, it's down, going back from 1988 to the present. But you can see the blue line, MSCI USA versus the All-Country World Index excluding the US, and that has clearly been up. But that right now, just take a look. Since the financial crisis, it has gone up to such a degree. Not like before, okay? It's up, it's down, it's up, it's down, it's all over the place. But since that financial crisis, it's only been in one direction. Sure, there's been a slight pullback back in 2020, but not by much. Now, this part of the video, I want to talk about a little bit of an obscure subject, but hang on there. Stick with me, okay? This is important. We're going to be talking about free float. So I just wanted to show you this to give you insight as to what that means. Essentially, I have it written down because I want to be very clear about it. The share of government debt held by price-sensitive investors. What's a price-sensitive investor? That's people that are not central banks and can't just print money. What the ECB dubbed the free float. Okay, that's key. Take a look. This is a particular paper saying how shocks to government bond duration risk held by price-sensitive investors affect the euro area term structure of interest rates and the wider macroeconomy. A lot of jargon there, GPS. What are you talking about? Well, essentially, this all means that how much of a distortion is being created by what these central banks do? Well, long and short of it is, it's a lot. We construct new measures of the bond free float, which adjusts the total debt for foreign official holdings and weights by residential maturity. Just goes on to basically say that there is an impact, and they give you the details. That's what the report was about. But look at this. US, FX, foreign exchange reserve holders, and Fed drive the free float. Should that surprise anybody? Japan, the Bank of Japan, QE absorbs the largest share of Japanese government bonds. No surprise here either. Germany, foreign central banks are the majority holders of bonds. People want those because of the stability, perhaps. And the UK, early start to QE, makes the Bank of England the largest gilt holder. All in all, the more intervention you get, the more distortion you create. Global free float in percentage of the outstanding debt that has been declining from 2004, nearly, I would say probably 54%, down to about 40% today. And then the global free float in the trillions of dollars. Just looking at this, different countries, how that has increased over this period of time. The central banks are actively trying one very important task, one action, and that is to buy everything. I don't think people realize what the actual goal of these central banks is. It's to create the boom-bust cycle to allow for an unbelievable dependence on central banks. We're already there technically, and we saw some, and I'm using this word not lightly, unprecedented actions that they took with the special purpose vehicles, buying up anything and everything, buying up corporate bonds of Apple. I mean, come on. And now we go into a whole new different world. You know, this can go on forever. We don't really know what will be the trigger, what will be the catalyst. But you as the individual need to protect your portfolio. You need to watch your retirement accounts. You need to be careful about all the actions that your government's taking to distort what you have been working so hard for. If you appreciate that message, if you appreciate this information, simply hit the thumbs up button. You're helping me out. You're also notifying a group of people out there who has no idea what the money GPS is. And that thumbs up will signal the algorithms that this is some good stuff. So I do appreciate that very much. If you haven't seen this video yet, you definitely want to check it out. So just click it and I'll see you there.